We are back in the black hole of real estate, and everybody, and I mean everybody right now, is focused on these presidential elections that are before us right now. And I thought it'd be a good time to talk about what happens in the real estate industry during a presidential election. Hey, this is your host, Ron Weiss-Sakarski, for the black hole of real estate. And you're wondering and waiting, maybe hoping for your president of choice that you're going to vote for, and I do hope that you vote. I think the most important thing, by the way, is just vote. You get a say, you get a chance to vote, and if it goes your way, great, and if it doesn't, that's fine too. I mean, we vote and that's it. But if you don't vote, hey, I mean, do you really have a right to complain if you don't vote? So that's my only political message for the year. But more importantly, what happens to the real estate market based on a presidential election? A couple things. I am not of the belief that whoever gets elected causes the real estate market to change dramatically in one direction or the other. Now, with that said, in recent history, and let's say the last 15 or so elections, all but one time, prices have gone up in the following year. So I don't think that falls across a party line or a particular president or a particular economy, because there's been ups and downs and all arounds, during that time. So in general, real estate prices have gone up all but one time. And if you follow the last 100 years, the top two investments, they've been real estate number one and the stock market number two. So it would make sense that prices could very well increase, even if it's only a little bit, in the year ahead. So let's just get that right out of the way right now, that prices will probably go up just a little bit. I would also add that if there was not a presidential election happening very, very soon, that the conditions of the market are such that prices would probably go up a little bit in the next year. And I'll give you some reasons why. Inflation has been super high, and the Fed has been making all sorts of adjustments trying to tame inflation. Now, whether they've tamed it or not, they've taken steps that perhaps in the next year they'll have it a little more under control, maybe a lot more under control. That would ease the strain on consumers and might allow enough time, energy, money, and vision for them to think about moving. Interest rates. They've reached super high rates and accelerated very quickly over the last few years, and have come down a little bit, not a lot of it, but I do believe that as the economy perhaps strengthens or inflation tapers, that there'll be room for a lower interest rate, which would increase purchasing power for buyers. And as that begins to happen, more of the people that have been holding on and not selling their property because they didn't want to give up their 2 or 3% interest rate on their primary home mortgage and trade it for a 7 or an 8, well, the gap is much smaller now than it was a year ago. Chances are the gap is going to narrow between now and the next year. Also, one reason that people might be looking, because affordability will be a little bit better even if the prices go up a little bit too, because the dramatic decrease in interest rates, if it happens 0.5% or 1%, if we get somewhere in the fives, mid fives, it's going to save hundreds of dollars a month on most mortgages. And if the price goes up a little bit, you're probably still a little money ahead. But it's more to the point that a rate in the fives historically has been super good, and I think be overly attractive to most people. I think at 5.875% when they hit there, I think that you'll see a push in the market of buyers jumping back in strongly, more strongly than they are right now. I think it's going to make it easier for sellers to go on the market, but with the pent-up appetite for people that have delayed a move, I don't know that new inventory is going to last on the market very long. And there's the catch. Will we go back to the craziness of a few years ago during COVID when homes were selling way above the list price in a matter of minutes with multiple offers? I'm not predicting that. Special circumstances were occurring right at that moment, and people were supremely motivated, and rates were super cheap. So there was just a lot of things that conspired at the same time to make that possible. Now, I think with low rates but moderate, more accustomed to what we've seen historically, Inventories are still super low. They are nowhere near the pre-COVID numbers, and I might say in a lot of markets it may not even be half. But if days on market have gone from, let's say, 10 seconds or a day or two to a week and then a month, and even now if it's 2 months or 3 months in your market, it seems like a long time. But in a balanced market, what they tell us is that a balanced market is when you have a 6-month supply of inventory. Well, if it's taking 6 months to sell a house, most listing contracts are actually 6 months long, at least the ones that I have seen. It means that most are selling during the time in the first 6 months. But a balanced market, being that, most sellers would not be accustomed to waiting 6 months to sell a house. They would expect more like 6 days or 6 weeks. So even if we had a lot of people jump into the market, as they get bought, it's going to take a lot to double the inventory. And I don't know that you're going to double the inventory from what it is today to get to a balanced market. And even though it's just balanced, it would not be called a buyer's market until it went way beyond 6 months. It's just balanced. At 6 months, it means it's equal for buyer and sellers. And we're not there. So would I tell you it's a seller's market? I'd be a little cautious of that, because right now buyer demand is low and inventory is low. When the buyer demand increases, it may be a little more in favor for the sellers, but I think with the incoming new listings, where's balances we're going to be is what I'm trying to say. It's slight advantage to the sellers because of low inventory, and as the rates come down, buyers will jump in, whether it's someone for a single family residence that they're going to live in for a long, long time, or someone that's going to use it as a vacation home. A lot of vacation homes got sold. People might be jumping back into the second home market. Airbnbs, a lot of those got sold off, but some went to long-term rentals. We'll see about that market. And then, of course, the investors and flippers, they've been out because of low inventory, and the rates have not been favorable for the investor loans, hard money loans, and the like. A lot of those people are on the sideline because as you go to flip a property, it's got to sell for more than what you paid for it, including and factoring in the cost of materials and labor. And then again, you also need to factor in a profit for that. So when a flipper is in a situation where the best they can do is break even after expenses, they just ride it out on the sidelines till inventory comes along. So inventory, I don't see it spiking. It would have to double for it to be a balanced market, and we're nowhere near that. So let's walk it all back. What you really want to know is what's happening with home values. My prediction is simple. They'll go up next year, because it makes sense from all the economic leading indicators that we would study. Inflation will be lower in all likelihood. Wages go up a little bit. Interest rates will come down a little bit. Prices go up a little bit. That just seems to be a lock. And if you're looking for something a little less rigid on leading indicators and maybe just historical, all but once prices have gone up during a presidential election year. That might be something. Historically, real estate has been the best investment, followed by stocks, and it's gone up over time. So everything points to home values going up a little bit. I do not see the bottom falling out. If it was going to happen, it would have happened for a lot of different reasons, but it was never going to be 2008 over the last few years. Certainly, if it was going to drop, it might have dropped during COVID. It might have dropped dramatically when interest rates were 7 and 8%, and now it's lower. So there's nothing that suggests that prices will come down because the demand curve says so. So now with that in mind, what do you do next? If you're a seller, weird that people say people don't buy homes over the holidays and November and December are quiet. I can tell you my personal business, and this goes back 15, 20 years. Of the top 5 months we've had, 3 of the top 5 occurred either in a November or a December. We've had a really good July and a really good August. Now, we've had other really good months in the summertime. But the end of the year has been a really good time too. And why wouldn't it be? If you're an investor and you need to make some sort of a purchase because you're trying to work the tax system, maybe you need to sell something for the same reason. Interestingly enough, let's say that you made a lot of money this year. Could you sell a profit at a loss if you're financial advisor said you need to lose a little money or you'll pay it in tax, but you might lose a little bit on the investment. And let's say that you bought a home for $300 and you, for some reason, condition, damage, otherwise, or maybe a tough market, you sell it for $250 and you lose $50,000. Maybe that washes against your taxes, but it puts $250 in your pocket to go reinvest and reallocate, and perhaps the tax benefit followed by reallocating that $250,000 into something else could get the 50 back and put you ahead of the game after the tax consequence. So this is what people are thinking about at the last 60 or so days of the year of what we have left in order to fulfill a tax strategy, an investment strategy, or just to acquire another door. Investors are absolutely happy to look at something that will bring in cash flow. And if the rents are solid and the price is right, an investor, well, they're going to buy that property in the name of cash flow because the returns are solid. And they control the asset. And if they also believe that the value of the home is going to go up next year, well, to them that might be a triple win. It's a cash flow coming to them for guaranteed income through a lease. There's a write-off available. They depreciate the property, and then they get the appreciation because the value goes up. I think investors will be watching this market and making some purchases before the end of the year because of the triple compounding effect of the money that they would make. And I also think some investors out there made a bunch of money, might sell something even if they want to get something out of the portfolio. Let's just say there's a property that doesn't fit anymore. Taking a loss at the end of the year might help them out tax-wise and put more money in their pocket to reallocate. So that's what I got for you today. Again, home values. Do they change because of who gets elected? I don't think so. But do they change during election years? Absolutely. Upward. And by the way, there's a lot of leading indicators that suggest the prices are going to go up. I hope this helps you out with your decision to get yourself off the fence if you're ready to buy right now but hesitant. Or maybe this just helps you out with a strategy that helps you out tax-wise and in your wealth-building strategies. This is Ron Wojciechowski for the Black Hole of Real Estate.